You probably clicked on this video because either you're holding Pure Storage stock or you're thinking about holding it. Well, we're in the latter camp, and our intention is to get some more exposure to the big data theme. We have some already in our 36 tech stock portfolio, but we're considering possibly increasing exposure to big data. And one way to do that, perhaps the ultimate pick and shovel play, would be to invest in hard drives. Now, we've already covered that theme in a previous article and presentation, and I'll provide a link to that research piece in the description of this video. It talks about why we're looking at Pure Storage, and the idea is today we're going to figure out if it's investable. So the first thing that we really like about the firm and what we look for in any company we invest in is leadership. So this is Gartner's popular Magic Quadrant, and for 8 years running now, Pure Storage has found its way up into the upper right corner, which is where you want to be on this quadrant. And they're competing with names like Dell and NetApp and IBM and Hewlett Packard, what's now referred to as HPE. So we know that Pure Storage has leadership, and they're doing something called Flash Native, and you can read our previous piece, which talks about the advantages of that, but mainly it boils down to this. And Andreessen Horowitz said, software eats the world. He said that, I don't know, a decade ago or something like that, and he was darn right. So now you see the emergence of software as a service companies, one of our favorite business models. And software is what allows Pure Storage to do what they do. So if you go into their 10K, they list 3 technological advantages they have. And these are those advantages. The first is they're direct to NAND software. So they're talking directly to the chips as opposed to using any sort of intermediate layers. They're integrating the hardware and the software together. That's kind of saying the same thing. And then they have these data reduction capabilities. So when they store data, they can do it a lot more efficiently. And the end result is that they're able to offer flash drives that are not only better, but also cheaper. So Pure's flash drives require 1/10 the amount of power, space, cooling, and e-waste of magnetic disks. Those are the traditional hard drives that we're all familiar with, should be familiar with. And then up to 1/5 the amount of power and cooling of competitive all-flash systems and half the space required. So competitive all-flash systems have been traditionally built by firms like SanDisk, which now belongs to Western Digital, and some of those names that we mentioned earlier, but they've been built on platforms that make a lot of assumptions. So if you think about Elon Musk's idea of first principles thinking, let's start from nothing and build something and get rid of all the pain points along the way. And that's what Pure Storage has done. So their drives now cost less than a hybrid storage array. And a hybrid would be a combination of solid state and hard drives, where you're kind of getting a little bit of the best of both worlds. But what's really interesting to look at, and there's a firm that produced a phenomenal research piece looking at this. The detail is incredible, and there's a link to that research piece in our own research piece. And it talks about how the total cost of ownership, when you consider not just buying the hardware, but the cost to service it, the electricity needed to power it, the space to store it in, etc., that's the total cost of ownership. And if you compare that to a traditional hard disk drive, there's a positive net present value. So what you can do, and MBAs are taught how to do this, is you go and build a spreadsheet that looks forward 10 years, and you start making assumptions, and you use the weighted average cost of capital, and you do all these fancy things essentially to figure out what's the actual cost of what I'm buying over its lifetime. And Pure's hardware saves companies money, which is why their revenue growth looks like this. So this reflects their quarterly revenues over time. You can see that there's some cyclical element where the fourth quarter is consistently higher than the first quarter of the year following it. So it's something to note there. And also 72% of their revenues were from the United States in fiscal 2022. And that number actually fell year over year and was about the same compared to the prior year. So it would be nice to see them get more international diversification. Ideally, we never want to see a single country represent more than half of a company's revenues. Now, when we're talking about revenues, there's actually two types, and this was something quite exciting that we noticed about Pure and quite liked. So firstly, notice how their product revenue is on a decline from 2020 to 2021. It declined 8%. Well, of course, they're going to blame that on the Rona and the supply chain problems that are being caused by the bullwhip effect. And that's fair enough. And then when you look at their subscription services, you can see that those grew by 33%. So they were able to overall grow their revenues from year to year by about 2%. Now, a couple of things to note here. First of all, when you have a hardware company that only sells hardware, that's a real concern, because what happens when the demand for hardware goes down? Well, it's nice to have subscription services that accompany that, or some form of recurring revenue streams. And these subscription services are what they're calling storage as a service. And you can think of it like a SaaS offering, except clients are paying for data that they store. And we'll talk a little bit later about why we like that particular model. Now, one thing to note here is that the company says the effect of significant downturns in sales of subscription services is not reflected in full in our results of operations until future periods. In other words, there's a lag here. So product revenue dipped, maybe subscription revenue dipped as well, because that will be a lag that will only be reflected later, perhaps next year. So that's something to keep in mind. But what you can watch instead is this annual recurring revenue number that they provide for the subscription business, which is 849 million. That's a year-on-year growth of about 31%, and that's important. That almost matches the revenue growth that you can see here between 2020 and 2021. Now, that ARR number simply reflects what customers are contractually obligated to pay at that point in time if nothing else changed. And of course, they haven't paid that yet, but you can think of it as revenues captured versus when revenues are actually recorded. So that's something investors should be keeping an eye on. You can find that in the 10K. I don't know if they provide that number in the 10Qs. When it comes to customers, now this is not a SaaS business, so we don't have SaaS metrics, but wow, we've got these two metrics here on the lower right that are quite interesting. The first is incremental purchases from customers within 2 years of an initial purchase of $1. So they spend $1 with Pure Storage initially, and then after 2 years, they're spending $2. That's a 100% increase in expenditures. That's very good. That's kind of the concept of net retention rate. Are you able to get your existing customers to pay more? Then the second number talks about how the top 25 customers within 18 months of their initial purchase of $1 are spending 11 times as much. So that's very exciting. And then you can see here that they have over 10,000 customers, and around 52% of the Fortune 500 use Pure Storage hardware, and they continue to add customers. So these are very promising numbers, but of course, it's not a SaaS business, so some bits are lacking. So again, as we mentioned, we don't have this net retention rate number that we can monitor to make sure that existing customers are spending more. And we have no insight into subscription service profiles. So what does that spread look like? We know that no single customer accounts for more than 10% of revenues, but we don't know a whole lot about the subscription service and various characteristics of it. So in lieu of that information, I think there's a couple things we can pay attention to make sure that they continue to sell to existing customers and that they don't have cancels, which SaaS companies refer to as gross retention rate. So firstly, this net promoter score, NPS, they're in the top 1% of all B2B companies. That's just an indicator of how happy customers are. If your customers are happy, they're probably not going to cancel. And they're also able to compete on cost very well. We noted their gross margins are very high for a hardware company, and that's because that they're able to build drives with their software using flash chips that are quite cheap to build, and they're able to sell them still at a competitive price and generate a lot of cash. So when we look at the company's margins, we've taken this from the 10K. You can pull this up yourselves, but this is interesting. So from 2020 to 2021, we see product gross margin dip a bit there, 200 basis points, and we see subscription services grow. Now, if your subscription services are being sold based on data used, that's a great business model because your clients keep using more and more data storage and paying more and more for that usage. And then the incremental cost to build out your platform is less. So then your gross margin expands. So you can see product gross margin decreasing, subscription gross margin expanding, overall gross margin dipping a bit, but we would expect those two variables to offset each other. So as product margins are squeezed because they need to remain cost competitive as time goes on, then subscription services will help offset that. So it seems to be a model that works quite well. Now, when it comes to survivability, that's something we're focused on these days, given the bear market we're in. Pure has 1.2 billion in cash right now. They burned through 11 million last quarter versus 80 million the same quarter the year prior. So they're certainly becoming a lot leaner as time goes on. But if we just use the 143 million in losses from fiscal 2022 as a proxy for their cash burn, we can see that they still have quite the long runway. Now, the only minor concern here would be their key input being flash chips. What if there's a problem supplying flash chips? Well, they're a commodity, and you'll recall, I think it was in 2017, there was a bit of a crisis, and the price of flash chips stopped decreasing for a couple of years. It even temporarily increased as the industry tried to manage through that. So keep that in mind, that flash chips are a key component of what this firm does, a key input, and that, of course, that services segment will help offset any disruptions in product revenue, similar to what we've seen in the last year, actually between 2020 and 2021. So the last thing we wanted to mention here, just the competition and market share. Pure Storage isn't a leader yet, so they have about 13% market share. It's growing very fast because they're competing against Dinosaur, Dell, and NetApp. And Pure Storage is also competing against Western Digital's SanDisk. After they purchased SanDisk, that became a division of Western Digital. So there's talk that that might be spun out, which would give us another pure play company to look at in the SSD space. But these are the competitors. And the only point we wanted to make here was that Pure Storage isn't a leader yet, though they're the rate at which they're growing, it wouldn't be surprising if they became a leader in not too quick a time. So when we look at the valuation of this company, we take what's called our simple valuation ratio, market cap divided by annualized revenues. That's a little tricky, right? Because the fourth quarter revenue number is always higher than the first quarter. But at any rate, it's around 3. And pretty much every company is in the single digits these days. So it doesn't tell us much except that this isn't wildly overpriced by any means. So just to conclude, Pure Storage is a pure play on big data growth, high margin hardware and services combo. They've solved that. Most hardware companies have that problem where they've been selling hardware and they have to figure out how to add recurring revenues very quickly. SolarEdge is doing that. The other thing to note here is it's not a blue ocean total addressable market. So Pure says they have about $60 billion to capture. Well, they're having to steal that from competition, and that's a lot different from selling something that nobody else is. For example, might think about Illumina's machines, right? And how they were they became the de facto standard. So Pure may indeed do the same thing, but they have to displace the competition. Though, to be fair, they're doing a very good job of that. So the only question that we have following this presentation, we certainly like the company and we're mulling over the need to get more exposure to big data, but is there a better alternative? And we think we might have a company of interest. So that will be a coming video. Please put your comments in the comment section, subscribe to our channel. Thanks so much for taking the time to listen to this presentation today.